If you've ever asked, where should I invest my money? You've probably come across these terms: index funds, mutual funds, hedge funds, and ETFs. But what's the difference? Which one builds wealth? And most importantly, which one is right for you? Stick around, because by the end of this video, you'll understand exactly how these funds work, who they're for, and which one can help you reach financial freedom faster. Hit that subscribe button, and let's break it down. Hey there, welcome back to the channel, where we make money simple and smart. Today, we re-dive into 4 of the most talked about investment options. And if you're serious about building long-term wealth, you need to know the difference. Let's start with the basics. 1. Index funds. What are they? Index funds are a type of mutual fund or ETF that aims to match the performance of a specific market index, like the S&P 500 or NASDAQ 100. How they work? They don't try to beat the market. Instead, they just track it. This passive strategy keeps costs low and performance steady. Pros: super low fees, diversification. One purchase gets you exposure to hundreds of companies. Historically, strong returns over time, best for beginner investors, long-term retirement planning. Fun fact: Warren Buffett once bet that an index fund would outperform hedge funds over 10 years, and he won. 2. Mutual funds. What are they? Mutual funds are pools of money collected from many investors, managed by professionals who decide where to invest in stocks, bonds, or other assets. Active versus passive. Some mutual funds try to beat the market, while others just follow it. Fees matter. Management fees are typically higher than index funds, and they eat into your returns over time. Pros: professional management, easy diversification, can be tailored to investment goals. Cons: higher fee, not as tax efficient as ETFs. Best for hands-off investors who want expert management, 401 or employer-sponsored plans. 3. Hedge funds. What are they? Hedge funds are private investment partnerships that use aggressive and complex strategies, like short selling, leverage, derivatives, to generate high returns. Who can invest? Only accredited investors, people with a high income or net worth. These funds are not for the average investor. Pros: potential for high returns, access to exotic investments. Cons: super high fees, high risk, lack of transparency, illiquid. Can't always pull your money out. Is only best for ultra-wealthy individuals. Institutions like pension funds or endowments. For ETFs. What are they? ETFs are similar to index funds, but trade like stocks on the exchange. You can buy and sell them throughout the day. Passive and active options. Most ETFs are passively managed, but some are actively managed now. Pros: low fees, tax efficient, can be bought in real time. Great for DIY investors. Cons: may require a brokerage account. Some ETFs can be complex. Best for investors who want control, those looking to build a low, diverse portfolio. Comparison table. Fund type: fees, risk, access. Best for index funds, low, moderate, everyone. Long term beginners, mutual funds, medium, moderate, everyone. Hands-off investors, hedge funds, high, accredited, wealthy. ETFs, slow, varies, everyone. Flexible investing. What's right for you? If you're just getting started, index funds and ETFs are your best bet. They're low costs, easy to understand, and proven to work over time. If you want professional help, mutual funds could work. Just watch those fees. And if you're already wealthy and looking for a risk high reward, maybe hedge funds are your playground. But remember, there's no one size. The right investment depends on your goals, risk tolerance, and timeline. Final takeaway: don't just invest blindly. Know what you're putting your money into and why. The rich don't guess, they understand the game. If you found this breakdown helpful, like the video, subscribe, and share it with a friend who needs to start investing smarter. Drop a comment below. Which fund do you trust the most? Let's build wealth the smart way. Thanks for watching. See you in the next video.